overseas, you with the ADRs, you feel that you're covering the world?
I do feel that way, and of course, many of the companies we invest in are multinational in nature, and so they're deriving a substantial portion of their revenue around the world, even if they're U.S. domiciled. But yeah, we do see opportunity around the world, and of course, it probably shouldn't be a surprise that we see opportunity in Europe, because Europe has been a disaster in terms of stock performance. And so I do think that there are attractive names there. I'll give you a couple. Credit Suisse in the financial sector, Ericsson in the telecommunications sector, Total, the big French oil giant, and then if you want one that's a little more speculative, Portugal Telecom. Nobody wants to invest in Portugal these days,
so
fearing
it's the next Greece. What, 15% yield?
Yeah, 15% yield is what you're getting on Portugal Telecom right now. I feel it's pretty secure, and it's certainly, you don't have a stock trading at a single-digit P with a 15% yield if everybody believes that it's secure. But management has expressed a strong commitment to paying out that high dividend, and they believe they'll have the cash flow to do it. And this is really a multi-year commitment out to 2015. So I think you're going to get some solid income out of Portugal Telecom, and I think you're going to get capital appreciation. And if you look at a stock chart over the last year, it's been straight down. Of course, it's bottomed a little bit and is on its way back, hopefully. But it's already discounted a lot of bad news. And the thing about Portugal Telecom is they have a big operation, a big stake in a company in Brazil called OI, Brazil Wireless, and that the value of that is actually equal to what the value of the operations are in Portugal. So it's got a growth area in Brazil, plus you have some operations in Northern Africa that are appealing from a growth standpoint. So it's not a company in our mind that's headed for the scrap heap yet, but the stock price sure looks like it.
Your point about dividends. So it's your belief, based on research you've seen, that those stocks do better over time than mini caps or small caps, even though nobody pays attention to them, and therefore they should be even more undervalued than those that are followed by everybody?
Well, you can slice and dice the numbers in a lot of different ways, and we have. And what we've found is that the highest yielding stocks over the long term. And then the nice thing is these days there's plenty of data available. We utilize data from Professors Fama and French, and they sliced and diced the investment universe in so many different ways, and we're able to take that and obviously track the numbers. But what we found is that the highest yielding stocks have outperformed, the highest 30% have outperformed the next 40%, which have outperformed the 30% lowest dividend payers, which have outperformed the non-dividend payers. And that's, again, over the long haul. So, absolutely, I think that the dividend theme is something investors should really pay attention to. The analytics we've compiled suggests that, yes, small and mid-cap stocks have historically outperformed, and so we don't shun them by any stretch of the imagination. We're all cap managers. But I look at it from, what's transpired since the turn of the millennium is that small and mid-cap stocks have gone up, and large cap stocks have flatlined or actually gone down. The S&P 500 lost a decade. And so on a relative valuation basis, large caps look attractive to me today because, of course, their earnings have continued to grow. And then you have the added multinational nature of their revenue stream, so they're geographically diverse. They have a greater preponderance to pay a dividend, and generally speaking, they're less volatile. So you get higher return with lower risk, which is, as I like to say, the holy grail of investing.
Right. In terms of psychology, the economy as a whole, you think companies were like investors? They overreacted to the disaster of 2008, and they're just beginning to emerge put their heads above the parapet?
Right. There's a slogan, "Get ugly early," which I think a lot of executives followed, which means that this is the big one. Let's batten down the hatches. Let's get rid of the fat. Let's get rid of the bone. Let's get rid of some of the muscle. And a lot of companies did that. And now they're sitting here saying, well, the world didn't end, and I'm going to start investing again, and my staff is just worked to the bone. I have to get a little more bandwidth here. And so absolutely, I think we're going to see the business world start to pick up the pace on hiring. And one of the companies that I like is Manpower. which is the global staffing company. And I like it because the executives, while they may still be ready to start to add a little personnel, they're going to be reluctant to hire those folks full time. And so the temporary staffing biz, I think, is going to do well here in the near term as executives really try to not to get caught with their proverbial pants down again by overhiring.
So how strong is the melt up, as you put it, going to be this year in terms of the economy growing just because people, okay, it's not the end of the world, so I'll do a little more than I might have been willing to do a year ago?
Well, I'm not a guy who's a raving lunatic in terms of economic growth. We're not going to grow at 4 or 5% GDP, but I do think we'll grow at a decent clip this year, and I do think, and we've already seen it so far this year, the labor picture is going to start to get better. We've seen excellent auto sales, we've seen consumer confidence,
Although
improving.
Even those aren't matched their peak yet.
Not yet, but again, it's all from where what was expected, right, and where you came from. I mean, we're sitting here today talking about an 8.3% unemployment rate, and that's good news. Imagine that. How could that be good news? But it's where have you come from? And so we're trending in the right direction. So, my year-end S&P 500 target, believe it or not, was 1,400, and we're not that far away, from where we sit today. Now, the average stock has done better than the S&P 500, so it's already been a fantastic year. But I still think there is that small chance, and you mentioned the term melt up, because we certainly had a meltdown in years past. I think there's a small chance that you do get an outsized return year just because so many people are out of the market. And we've already started to hear some of the heretofore doom and gloom crowd. Now, you mentioned Gary Schilling. Now, he hasn't yet decided that he's going to buy stocks. But you've seen some other of the doom people start to throw in the towel and say, I got to get some equities. And that, that kind of thing can mushroom. And before you know it, you're sitting here with, a 15, 20% return on the year.
What other stocks do you like? You've put out some paper on, I think, 13 stocks, and then in the recent issue had 12 that you liked, PepsiCo and others.
Right. I'm a guy who likes lots of stocks. We believe in broad diversification. I'd like to see at least 50 stocks in a portfolio. And of course, it's always tough to pick just one. So I'll rattle off a few of them that I like. I like this large cap dividend theme and relatively attractive valuations to their peers. So names like Waste Management, Walgreen, Norfolk Southern, the big railroad operator. General Dynamics, and another name
PepsiCo,
that I like, PepsiCo, yeah. And I just bought PepsiCo for my own portfolio. Here this month, and so I think I'm going to be happy with that. So that's one particular theme in the large cap space. We still also like the global commodity theme. I just would rather play it by investing in individual companies as opposed to the actual commodities. So I like Archer Daniels Midland, which is obviously a big commodity trading outfit, and Freeport-McMoRan Copper and Gold. If you want to actually have specific commodity exposure, they're primarily copper, not gold. And then if you really want to speculate, a la the Portugal Telecom, you can look at a little shipping outfit called Navios Maritime, which the PE is about the same as the yield, about 6.5. And they're a dry bulk shipper, which of course there's plenty of overbuilding that's gone on in that space, but Navios has long-term contracts for the majority of its ships, and so they've managed to continue to make money and continue to pay out that dividend all through the downturn in the shipping biz.
You say you like the stocks rather than the commodities, yet if you look at something like gold, the commodity has done better than the mines. Why is that?
Well, that's an interesting conundrum, is that you would think that the stocks should do much better, and we own a couple of gold mining stocks, one of which is Yamana Gold. Another we just bought, I can't say the name of it just yet, but Yamana Gold, AUY is a ticker there, is a name that we found attractive. I think that the democratization of the commodity space via the rise of the ETFs is why the actual commodity did better. Recall that the GLD ETF,
right,
that actually had more assets than the SPDR, the S&P 500 ETF. And that very day that happened, I want to say it was May or June of last year, was the precise day that gold peaked. And then gold, of course, declined in price. So I think that there's new dynamics obviously in play with the ability of the average investor to decide, well, I want to buy gold, but I don't want to buy gold bars or gold coins. That's too difficult. Now I can just punch in GLD. or the other ETFs that are related to it on my when I go to buy, and it's an easy decision. So it's no longer just, okay, I'm going to compare stocks to bonds and I got to do one or the other. Now you have the ability to invest in Vietnamese small caps if you want, or double short silver or things like that, where you didn't have that ability as an average investor, just as recently as a few years ago. So the investment climate has changed, which makes our job more difficult, but it also, I think, creates more opportunity for the stock picker to find more mispricings as a result of all the volatility.
Now, there's a reason why people are still fearful. Let's hit on those. Let's say Obama gets reelected. Capital gains with Obamacare and the expiration of the Bush tax rates goes from 15 to 24. Dividends, 15 to almost 45.
Right.
That would kill the market, wouldn't it?
Well, you would think it would. The ironic thing is that the markets seem to do better under Democratic presidents than they do under Republican presidents. And of course, depending on your political leanings, you might argue for the reasons why. Won't get into that here. But I do think that those are very real concerns. And that's, again, a headwind that we'll have to face. Now, people have gone broke trying to predict what Washington will do. Who knows where we'll actually be when it comes to that point. But again, equities, in my mind, are going to deliver high enough returns to investors to compensate them for the heightened tax situation. The other point I would argue is that our strategy is long-term in nature. So our objective is to try to have long-term capital gains, which are historically been taxed at a much lower rate, obviously, than short-term gains. So I think it argues more for strategies like ours that focus on long-term investing versus short-term investing. And you could almost argue that it might be good for investors to say, okay, I don't want to have too many short-term gains because I'm going to lose them all in taxes. I'm going to focus more on the long haul.
What impact, it's impossible to say, if we get a blow up in the Middle East? There's noise about Syria, but there's even more ominous noise about Israel and Iran.
Right. Well, again, those are all wild cards, and I come back to what happened in this country in 2001. I was here visiting you, your folks here on 9/11, actually coming into the Forbes headquarters as the first plane went over my head, and a very traumatic experience. And I look at it at what happened that year, and on September 10th of 2001, we were up 10% in our portfolios that year. Well, when the market reopened after 9/11, stocks, of course, cratered, but then they rebounded. And so at the end of the year, we were up 30%. So had you known that 9/11 was going to occur, your knee-jerk instinct would have been, I got to get out of anything equity-related and put my money in a suitcase or something. And it wasn't the right call unless, of course, you had great timing to get out and then get back in. But let's say you rode through all that. Your choice of riding through or getting out, 99 people out of 100 would have probably said I would have gotten out. But in reality, you would have been better off by staying in. So the moral of that story is that yes, there could be turbulence in the Middle East. What would happen if we had that situation with Israel and Iran? Well, oil prices would spike. We don't know what that would do, how long it would last, and so forth. Some might argue that it might be a good thing to stop whatever Iran might be doing there. Good thing for the long run, a bad thing for the short run. Again, you don't know exactly what will happen, but I still think that portfolios that are broadly diversified will be able to navigate those kinds of storms. And of course, we have energy stocks that arguably should go up. Just as in 9/11, we had a stock that went up 200% the day stocks continued to trade or started to trade again, and that was Envision Technologies, which made explosive detection systems, which, guess what, the government decided was going to keep us safe by buying hundreds of them, and they were big, expensive machines. So there's, the world will go on no matter what transpires. We've already seen that the markets survive anything. I like to say, cockroaches and capitalists will survive will survive Armageddon.
What about ants? John, thank you.
Thanks, Steve.